Why hello, welcome back to Accounting Stuff. I'm James, and in this video I'll attempt to explain the chart of accounts in less than 2 minutes. Start the clock. What is a chart of accounts? A chart of accounts is an organised list of every account held in a general ledger. You can think of it as an index that categorises a business's financial transactions into different accounts. What does a chart of accounts look like? A chart of accounts is usually divided into 5 main categories. We have assets, liabilities and equity, which are balance sheet accounts, and then revenue and expenses, which belong on the income statement. Each category is given a range of account numbers to keep things organised and easy to find. For example, assets might use the 1000s, liabilities could get the 2000s, equity the 3000s, revenue the 4s, and expenses the 5s. These 5 groups of accounts are the same across all businesses because they align with the structure of financial statements. But the specific accounts can vary depending on the industry and the type of business. Allow me to demonstrate with 3 quick examples. We have a service business, a retail business, and a manufacturing business. We'll start with a service-based business. Bring It On, which is an advertising agency. Its chart of accounts might look like this. Under assets, we have cash, accounts receivable, prepaid expenses, and property, plant, and equipment. This is the stuff that Bring It On owns, and as you can see, all the account numbers begin with a 1. Bring It On also has some liability accounts. There's accounts payable, salaries payable, deferred or unearned revenue, and accrued expenses. These represent the stuff that it owes to external parties, and the codes begin with a 2. Then we have a couple of equity accounts, owner's equity and retained earnings. These represent what the business owes to its owners. The accounts start with a 3. Then at 4000, we have service revenue since Bring It On provides services to its clients. And finally, we have the expense accounts in the 5000s. Cost of services, overhead expenses, interest expenses, and tax expenses. I hope that makes sense. Now let's look at the chart of accounts for a retail business. In this example, we have a pet store called Mr. Whiskerson's Pet Supplies. There are 3 key differences between this chart of accounts and the one for Bring It On. Can you spot them? First, we've included inventory, which falls under assets. Inventory represents goods available for sale. This is an important account for retail businesses because they sell inventory directly to consumers. Next, we have sales revenue instead of services revenue. This is because the main source of income for a retail business comes from selling physical goods rather than providing services. And finally, we have cost of goods sold instead of cost of services. These represent the direct costs associated with purchasing physical goods that are later sold on to customers. Right, let's look at a manufacturing business. Gunther's Golden Beans is a coffee roaster. It's a manufacturing business because it takes raw coffee beans and processes them through roasting, grinding, and packaging to create a finished product, which it then sells. This is a different business, so it has a different chart of accounts. As you can see, inventory has been split into 3 accounts to reflect the 3 different stages of production. We have raw materials, which represent the unroasted coffee beans and packaging materials. Work in progress, which includes partially completed products that aren't yet ready for sale. And finished goods, which are roasted coffee beans that have been packaged and are ready to be sold. A well-structured chart of accounts can help businesses stay organised and prepare financial statements. All we need now are some numbers, which we can get from the trial balance. I cover that in this video right here, so if you'd like to learn more, be sure to check that one out next, and I'll see you there.